My name is Brian Feroldi. I've been investing in the stock market for about 20 years now. When I graduated from college with a degree in business, I was essentially financially illiterate, became super obsessed with everything related to money, personal finance, and investing. I discovered over a period of years that the stock market was the best asset class for matching my personality. And I've been creating content and sharing what I know about the stock market ever since.
Awesome. Well, just awesome. Well, I know a lot of our listeners are, they're right behind you. They're investing in the stock market. They're kind of index fund, more focused people. Um, I guess like for those out there who aren't comfortable with investing in the stock market, maybe they're like, it's not tangible enough for me. Is there any little bit of reassurance for those maybe stragglers we got out there who haven't quite taken the leap to jump into investing in stocks?
Yeah, if somebody isn't investing in the market, that's probably because they just haven't learned the basics about the stock market. Before I understood what the stock market was, why the stock market moved the way that it did, I just thought that the stock market was a random number generator, essentially a giant gambling machine that you jump in when prices are low and you get out when prices are high, and that's how you make money in the market. I mean, once you see, for me, once I saw the long-term chart that showed the S&P 500 going from the lower left to the upper right for like 150 years. That was the first time that it clicked that, okay, maybe if you actually look at the stock market over a long period of time, then it actually becomes a wealth generation machine. And people, I think, intuitively understand that, because if you ever study what rich people do, people with actual millions and billions of dollars, a huge portion of their net worth is invested in the stock market. So there must be something about the stock market that at least rich people understand.
So I think actually I want to jump back a couple hundred years and talk about the origin, the history behind the stock market, the S&P, because I also think understanding that gives people a better place to understand investing and know why they should be investing in the stock market in the first place.
So let's start break down. I love breaking this down into simple components. What is a stock? A stock is simply fractional ownership of a corporation. That's it. It is a record-keeping tool for figuring out who owns how much of a business. Stocks were invented because it can become very complex as a corporation grows and it takes on more investors at different times and different prices to figure out who owns how much of this business. So stocks were invented to make record-keeping of corporations easy. Now, when you everybody here knows what a farmer's market is, right? A farmer's market is where people with money go to connect and exchange with people that have food producers. So the consumers give the food vendors money, the food vendor gives the person the food. It's an exchange. Well, all a stock market is, it's the exact same concept, but instead of exchanging money for food, they're exchanging money for shares in businesses with each other. And this allows people that own businesses, that own partial stakes in businesses, to get liquidity so they can sell a portion of what they own or all of what they own in order to get immediate money. So the stock markets have existed for hundreds of years. In the United States, the most common place that people would meet with each other to exchange money for stocks was on Wall Street in southern Manhattan. That just became a natural meeting point that business owners and banks and investors would meet up to buy, sell, and exchange with each other. That very process continues to this day. We just so happen to call that the New York Stock Exchange. And it's just a place that businesses, investors, and companies can get together to exchange money for businesses. Now, the way that people would find out for hundreds of years what the price of a certain publicly traded company was to look in the newspaper. That was the way that people got information about companies. So the Wall Street Journal for a long time was basically just printing tables of here's a stock, here's its price, here's how much it went up and down. And an editor the editor-in-chief at the Wall Street Journal, this guy named Charles Dow, he was tired of just reporting tables of numbers to his readers without giving them any context as to what happened in the stock market that day. So he partnered up with a statistician and his business partner, whose name was Edward Jones, and the two of them added up these stock prices of 12 of the most popular, commonly traded stocks of the time, and they took the prices and they divided it by 12. And when you add up a bunch of numbers and divide by the number in there, that's called averaging. So they invented the Dow Jones Industrial Average, which was a way that Charles Dow could explain to his readers what happened in the stock market on that particular day, month, year. And that process, that Dow Jones Industrial Average, continues to this day, and it's still one of the major ways that investors figure out what happened in the stock market.
I think another foundational kind of stock mentality thing for listeners to consider, maybe they've got confused. I know I hear this confusion a lot, is around pricing. Like, okay, you've got this behemoth of a company like Coca-Cola, and maybe their shares are, $12, $15 a share. But then you might have some random company you never heard of that stock is $100 a share. And when somebody looks at that, they're like, wow, this stock is super expensive. This one's really affordable. Is that actually how you should be thinking about it?
This is something that's incredibly confusing because in every part of our life, the price of something tells us roughly the quality of that thing or at least the value of it, right? We all know intuitively that a $100,000 Bentley is a better quality car than a $20,000 Toyota. Like we have a strong connection in our minds between the price of something and the value of it or the importance of it. That connection absolutely breaks down when you're looking at the stock market because the price of a single share of stock tells you absolutely nothing about the quality or the size of the company behind that stock. So this is why people can get so confused about prices. Apple has about 15 billion shares of stock outstanding, meaning in total, there's about 15 billion shares of Apple's stock. So the value of Apple, the entire corporation, is essentially, well, what does one share of Apple trade for times 15 billion shares outstanding? That is the total equity value of Apple, of a company. And that number today is around $2.5 trillion. Apple is one of the biggest companies in the world. But that $15 billion number, how many shares they have, that is a completely made up and arbitrary figure. There are 15 billion shares because Apple's board of directors and management team decided that's how many we want. That's it. They could wake up tomorrow and say, instead of 15 billion shares, we want 150 billion shares. And instead of our stock being $200 per share, we want it to be $20 per share. So, but in that case, if they did that, which is just called splitting their stock, the total value of Apple, the company, wouldn't change. It would still be $2.5 trillion. So you can't infer just by looking at the share price, the value or the size of the business. That's because the number of shares that are outstanding is a completely made up number by each individual company.
And this is precisely why people are scared of investing. So thanks, Wall Street. Thanks, whoever made up this convention of buying stocks. It's so confusing for folks who aren't absolute finance nerds like us. You're right. Seeing $10 versus $1,000, you're like, of course, $1,000 stock's better. But okay, I think we set a pretty good framework. And the reason why we're asking you all these stock questions and about the stock market is about the topic we're going to be discussing for most of the episode today, stock-based compensation. Now, Justin actually has a lot more practical knowledge of stock-based compensation. I never had access to that. I quit corporate America pretty early. So I have a lot of these like genuine questions. I don't know how it works. I don't know the best ways to take advantage of it. And Brian, you sent over this monster doc. I was going through it. I have a lot of questions. So we're going to do our best for the listeners, for myself, personal curiosity, to get through a lot of this stuff and just kind of understand what stock-based compensation is, how you can best take advantage, mistakes to avoid, all that good stuff. So let's start off from the top. What is stock-based compensation for those who have never heard of this concept before and are willing to learn?
Yeah, I think it's a very important topic, and I actually think it's one of the least discussed, yet dare I say, lowest risks paths to actually achieving financial independence. If you join a company and get a good amount of stock-based compensation, and that company goes on to be successful, you can literally earn as an employee an extra couple $100,000, or in some cases a couple of $1 million in a relatively short amount of time, and that can obviously turbocharge your path to achieving financial independence. So what is it? At a very simple level, stock-based compensation is when an employer compensates their employees with company stock, aka equity, instead of paying them cash. So instead of your employer giving you a cash salary or a cash bonus, they simply give you shares of their company or the right to buy shares in their company at a future date. And if that stock that they give you, or they give you the option, goes on to go up in value a lot, well, you, the employee, can earn a tremendous amount of money.
Like Cody said, I do have a little bit of experience with this, but most of my experience, I think, is with publicly traded companies. But I think one that more interesting one to break down, which I'm sure we'll break down both, is kind of the nuance when this is a company that you can't even buy the shares on the market anyway. So like, what are you actually getting in this scenario? What do you call that when you're working for a company? Because maybe there's somebody out there who's doing some job interviews with a startup and they're throwing around some really interesting sounding numbers. Like they're going to give them $1 million in stock options. What kind of value are they actually being offered there?
Yeah, so this is something that confused me. There are public corporations that you can buy shares in, right? Anybody can go on their app and buy shares in Apple or Microsoft. So everybody understands, or most people understand, that public companies have shares of stock. Well, that same concept applies to private companies as well. It's not like when a company goes public, it all of a sudden has stock. Private corporations are also owned by shareholders. It's just that you can't see the share price that their company is trading at any given time. Let me give you an example. When I graduated from college, I got a job with a startup medical device company. And right out of school, as part of my compensation package, they gave me stock options in the company that gave me the right to buy stock in that company for about $1 per share. So I got 2,000 shares of stock of that company that I could buy for $1 per share. Now, through sheer luck, that company that I joined went on to be phenomenally successful. They're about a $12 billion company today. And had I held on to every share that I was given, I did not. I sold them over a decade ago. But had I held on to that initial stake would currently be worth about $600,000. So I was essentially given a stock option in a company that was not publicly traded at the time, and that went on to be worth a couple of hundreds of thousands of dollars. So private companies, small startup companies, can have stock, and you can actually get stock in those companies, even if you can't see the share price on some exchange.
And can I just, for one little clarifying question, when you're given that option, right? You're given the option to buy, in your case, you said 2,000 shares. That means that you have to put in $2,000 if it's trading at one share of your own money, correct? Like they're not giving you $2,000 worth of stock. They're giving you the ability to buy 2,000 shares at $1 a share.
Yeah, generally speaking, when it comes to stock-based compensation, there are two primary categories. Category one is called a stock option. That is when the employee is given the right to purchase shares in that company for some set amount of time at some set price. So again, for me, when I joined this company, I was given the right, not the obligation, but the right to buy 2,000 shares of that company stock for about $1 per share. And that contract lasted for 10 years. So I started in 2004. I could exercise it at any point for the next 10 years. So if I wanted to exercise that, let's say that I found out the stock was trading for $10, right? I could buy the stock for $1. I had the right to buy it for $1, even though it was trading at 10. That would obviously be a good thing to do, to buy a $10 stock for $1. But to exercise my option, you are correct. I would have to buy those 2,000 shares for $1 each. So I would have to invest $2,000 in the company, but instantaneously, because the company was trading at $10, those 2,000 shares would be worth $20,000. So I had effectively an $18,000 gain on that stock. So that's a stock option. It is the right to buy that stock in the future. Another type of stock-based compensation is called restricted stock. And this is when the employee just gives you ownership of those shares directly. You don't have to buy them. They just become yours. So if you have a choice between taking stock options or restricted stock, always go for restricted stock. That essentially is stock that just instantaneously becomes yours as it vests.
So this sounds awesome from the employee side. You're like, I could have got $600,000 in equity. Sometimes it could be millions. Why do employers do this? Why don't they just cough up a couple grand as a bonus, or pay them a little extra salary so they don't have to give up equity in this company they worked so hard to build?
Yep, and lots of employers do not pay stock-based compensation, or they don't give out equity to their employees at all. But the primary reason why companies offer stock-based compensation in the first place is to deal with something called the principal agent problem. The principal agent problem. You see this problem pop up everywhere once you start to understand it. So this problem is essentially stating that there's a conflict of interest between the owners of the asset and the managers of the asset. To give you a really quick example, imagine that I was hired to mow my neighbor's lawn, and my neighbor said, "I'm going to pay you $20 per hour." Well, if I'm paid an hourly rate, I literally have a disincentive to work hard. The longer it takes me to mow my neighbor's lawn, the more I get paid. Now, my neighbor obviously just wants his lawn to be mowed in as short of a time period as possible. But because of the structure of the paying me on an hourly basis, I have a disincentive to work hard. The less hard I work, the more money I make. That same conflict, that same tension exists between investors in companies and managers of a company. So the reason that companies pay managers and employees stock-based compensation is to make them part owners in the business, and therefore to give them an incentive to see the business increase in value so that they get a piece of the upside. And what that helps to do is to combat the principal agent problem, to align incentives.
No, that totally makes a lot of sense. I always say that, like, I feel like incentives are always the root of the problem. Like when you got an employee that's not doing the right thing, or someone's selling bad deals, like most of the time it's not because you've got a people problem, you've got an incentive problem. But an incentive, you need something of actual value. And so if you're in this startup lane, this stock option lane, you mentioned, okay, if it's trading at $10 and I got the option to buy it for $1, it's like, boom, I'm kind of overnight making some money. That's only true if you could sell it, right? So if this is not a publicly traded company, what do you really have when now I've traded in, or I've exercised my option to buy. I now have 2,000 shares that I bought for $1 that today is worth, say, 20,000. So now I've got this like $19,000 of capital gain sort of sitting there. How do I make that real gain?
Yep. So this would depend on the company that you work for. If the company is not publicly traded, you are right that you could exercise that option. You could become an owner. You could take ownership of those shares. But since there's no liquid market for you, if you wanted to sell those shares, it would become a very big hassle. What you would effectively have to do would be to find a private buyer, either in the corporation you work for, an outside investor, to say, I have this stock, I'm looking to sell it, and you would have to go through the process of finding an actual buyer for that stock. That is a much easier thing to do when your company is publicly traded, because you see a quoted price for the stock, and you can just sell it on the open market. Now, there are ways around that. The first way around that, if the company you're working for is private and it gets acquired, it gets bought out, all shareholders of that business are given a payment to take full ownership of their shares. So you can get liquidity if your company gets acquired. So that's way one. Way two is some companies have internal stock markets for their company's stock. Companies such as like the NASDAQ, which I think many people have heard of, they actually provide this service to companies, to big employers, and they essentially create these days, usually 2 or 3 times per year, like every 6 months, where employees can exchange money and exchange shares with each other. And the NASDAQ and other companies like that will actually provide a liquidity pool to actually allow employees to sell. But this is a major reason, what you just brought up, Justin, is a major reason why companies that are successful end up going public. Like Facebook, for example, did not need money when it came public. One major reason why Facebook came public was to give its investors, which included its employees, its management team, and all of the venture capitalists on Silicon Valley that put money into it, a liquid way to sell their assets. So that is a big reason why companies, once they reach a certain size, actually come public, is to make it easy for their shareholders to get liquidity.
And most companies, again, I'm completely in the dark with this stuff, that do offer some type of stock-based compensation, do you oftentimes have wiggle room or negotiation? Can you say, hey, I'll take a $10,000 haircut in my salary to get this extra stock-based compensation? And with that being said, if the answer is yes to that, what are some rules of thumb when it comes to making those decisions?
To answer your question, absolutely. When you are taking a job with an employer, negotiation is expected when it comes to your salary, to your bonus, to your vacation. A part of that negotiation should absolutely be your stock-based compensation package, if you have the flexibility to do so. Now, the amount of stock-based compensation that a company is legally allowed to give or to offer to employees, there are often rules about that are set at the board of directors level. So the person that you're negotiating with might not have as much flexibility on stock-based compensation as they do on others, but you should absolutely look to get a stock-based compensation for yourself. And one major reason to take stock-based, to focus on stock-based compensation is if you are working for a small, fast-growing company that you believe in, that stock-based compensation could be worth huge amounts of money in the future if you are successful. So take my example that I gave before, where I got 2,000 shares. I didn't negotiate at all. But if I would have said, I want 3,000 shares instead of 2,000. Well, that would literally have been a multi-$100,000 negotiation tactic that I put into place when I first started. So you should absolutely push for negotiate on that. Now, how much you take, or whether you should be willing to give up salary or bonuses in exchange for more stock-based compensation, that is something that you can offer to your potential employer. And if you really believe in that company and that company's long-term, that can absolutely be a wonderful, wonderful thing to do if you have the financial flexibility to give up less salary. But what you're doing in that case is you're giving up a known and a guarantee, like your salary, for an unknown. It should be said that if you're going to work for a very small company, the odds that that company goes on to be the next Google or the next Amazon or the next Facebook are exceedingly low, right? The odds of you working for a company that goes on to be publicly traded and worth billions of dollars is very, 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 very low. So you are taking a big gamble by accepting that stock. I don't know the exact number, but I would wager that a whole bunch of stock-based compensation that is paid to employees ends up being worth zero, because the company that is behind the business does not execute or goes bankrupt or fill in the blank reason. So you have to understand that ahead of time. Stock-based compensation is not a guarantee to riches. It's more of like a lottery ticket chance to riches.
Yeah, that's actually a big reason why when, I was looking at different companies and maybe considering, moving to a different company, I'd gotten so used to working for a large corporation that stock was publicly traded, that was very stable. Like, yeah, you may not get the 40, 50% returns that you could get on a smaller company, but you could kind of almost count on it being there, that I could see that as basically like another line of cash when I'm looking at an offer that I was getting from them versus looking at a startup. That was kind of maybe money. That was money that I wasn't using to really make a lot of decisions around. But just to, I guess, give a little bit of maybe my own personal experience answer for Cody's question is, I did see that, if you're looking to negotiate, you could probably say, you could probably fight for like a $10,000 raise 1 year, or you could fight for a $25,000 a year in stock. Like I would typically see, I would say around like 2.5 times the amount of value that they're willing to give you in potential money from stock than they would guaranteed money from like your salary. But like Brian was saying, if you're working with like a little startup, you got to be a lot more careful with that than you could be with a company that's got restricted stock. Brian, before we get too far into it, as far as laying some of that groundwork, you said a word earlier that I think is like a pivotal word to understand, because we talked about stock options, the ability to buy that stock, but it may not actually really have real value. It might be harder to sell. We also talked about restricted stock units, where the company's just giving that to you, and a lot of times you'll see this with these publicly traded companies where you've got this much more transparent view of value. But before you are able to take that stock and actually sell it on that public market, you need to vest. You said the word vest. So maybe we could break down what that word means, maybe some industry standards that people typically see. Like if they're being offered $100,000 of RSUs, what should they actually expect from like forecasting out how that money is going to flow to them?
Yep, this is a critical term to understand if you're going to be if you're taking on stock-based compensation. So, if I was going to work for a company and they gave me $100,000 in RSUs, well, you're absolutely right. On day one, it's not like I get 100 grand in stock. Stock-based compensation almost always comes with a vesting schedule, and that's basically a glide path that's based out over time for when that stock-based compensation actually become yours. Some numbers that I see that are industry standards are typically between 3 and 4 years. And by the way, this is another major reason why companies pay stock-based compensation, is because it encourages employee retention, right? Many employees actually choose to stay with their company for long periods of time, simply because if they left, then a portion of their stock-based compensation would not be theirs. So the typical vesting schedule is between 3 and 4 years. Let's just say it was 4 years for simplicity. A pretty common one is that on the anniversary date of your taking the job with the company, about 25% of that stock becomes yours. So let's say you were granted 1,000 shares of stock over a 4-year period. Well, 1 year later, 250 of those stock would become yours. The next year, another 250. The next year, another 250, and the next year, another 250. And that is just your initial tranche. It's fairly common for companies to give out annual payments of stock-based compensation, or to give out new grants. And what that does is layer in multiple tranches of these things so that employees have a constant amount of stock that is vesting, which again gives them quote unquote golden handcuffs, right? They don't want to leave their employer, because to do so means that they would forfeit a tremendous amount of stock-based compensation.
So I'm going to hit you with a loaded question and just let you run with it in whatever direction you see fit. Kind of similar to my last question, but let's say you have a company that's super generous with their RSUs or with their stock options. I know with the RSUs, you don't really have a choice. They're just kind of shoving these stocks into your pockets. With the options, you might have the option, like you did, to buy 2,000 shares. What is the right amount? Should you be maxing out for the options, I guess, in this example? For the options, I guess, in this example, should you be maxing out all of the, should you be maxing out the number of shares that you can buy from your company? With the RSUs, is there a point where you just have too much of that stock from your company and you're like, hey, I need to diversify. I don't want 30% of my net worth to be in this one company. Like, what's a good rule of thumb for how much of this company stock you should be keeping as a total percentage of your net worth?
This is an excellent question to ask, and the unfortunate answer is going to be it depends on everybody, right? Some people, myself included, I would not sleep well at night if 50% of my net worth was in a single company. Like, I would just not sleep well at night. I would be constantly worried about it. So for me personally, the quote unquote right amount of money to have in a single company, including my employer, would probably be 20 or 25% of my personal net worth. And this is a major reason why I don't own the stock that I mentioned before. I was selling it along the way, not because I wasn't a believer in the long-term potential of the company. I was sheerly doing it for risk management purposes. It would have been such a big portion of my net worth that I wanted to sell it down. as a general rule and a general statement, the more mature, the more predictable, the more the bigger a company is, the more comfortable you should be having a larger portion of your net worth attached to that business. For example, if you work at Facebook, and now it's called Meta Platforms, but if you work at Facebook and they're giving you stock-based compensation, by the way, they're a great company to work for. They give a ton of stock-based compensation. Facebook is huge. They have a wide moat. They have no debt. They have tons of cash. They are ridiculously profitable, and their stock is up like 20-fold over the last 10 or 20 years. If I was getting stock-based compensation in them, I would be very comfortable having a big portion of my net worth invested in Facebook's stock, simply because it was big, profitable, and it's not going anywhere anytime soon. On the flip side, if I just joined a small tech startup and that tech startup didn't have any revenue, or it had very little revenue, and they were still trying to gain product market fit, and the company was not profitable and had no chance of being profitable for years to come, I would be extremely worried about having more than 10% of my net worth dedicated to that business, simply because it is so risky and so unknown. However, those are just numbers that I threw out for myself. Some people that love risk, they might be comfortable working for a profitless company and having 50% of their net worth in that stock. And on the flip side, you might be so risk averse that even if you worked at Facebook or Apple, you might not sleep well if you had 5% of your net worth. So there's no exact number I can give there, but I will say generally, the bigger, more stable, more profitable the company, the more you should allow it to be a bigger, and the inverse is also true.
Yeah, I mean, I kind of a personal example of maybe where you start to get your allocations a little off skew for me was when I was working at this last company. It was announced they were going to be acquired. They set a price at which the company would be acquired for if the acquisition went through. So you knew what that price was, you knew what the current price was, and there was a delta there. And so I decided to just keep holding on to all my shares, because I knew as soon as that deal actually went through, if it went through, which wasn't, obviously a guarantee, that you're looking at like a 20+% return. So like Brian said, like every position is going to be different. Like everybody's in a different situation. Everybody's working for a different size company. Definitely those startup size companies, be a lot more cautious of how leveraged you're getting. But then another thing I don't think a lot of people consider is that you are sort of double leveraged. So, okay, let's say you've got 40% of your net worth in this company. Also, all of your income stream is from the same company. So like you are leveraged in multiple fronts. So if you're going to bet big on a company that you're working for, like that's you're in a precarious position. It doesn't mean it couldn't work out really well for you. And if you're working for the right company and you've got the right information, that you couldn't make some good moves. But like you are double leveraged. You're coming from the company and you're coming from the stock. One thing I wanted to kind of tie off on that vesting schedule thing we were talking about earlier is, Brian, like you mentioned, I think a very common one is 4 years, and you got that 25% at the 1 year anniversary. But then a lot of times you start to see the stock coming in at a more frequent basis. Like you have that 1 year, what they call a cliff, where after 1 year you get 25%, and then maybe you start getting like 6.25% every quarter. But you're going to get to a point where you're getting towards the end of that initial big grant, because like your sign-on grant is generally your biggest grant. And I just thought it'd be worth mentioning to people that this is a great time to really start that hard negotiation around your stock-based compensation, because those golden handcuffs start to get a little less shiny when you only got 6 months left of these RSUs. So generally when an employee starts to get down to where they're down to like 10-15% of that initial grant that came out, they're in this position to where they could get plucked by another company who's willing to offer them this big sign-on bonus. And so now you have a lot of leverage with your employer to ask for a big, for a big true up, a big new batch of stock.
Yeah, that's a wonderful point. Or it might be time to switch employers altogether and get a whole new sign-on bonus. I think a lot of people in your audience are probably credit card hacking, so they're familiar with switching from credit card to credit card, get a sign-up bonus. You can do the same thing with your career.
Gonna take a soundbite of that one. That's good. Okay, so talking about rebalancing, and I know for Justin, he was getting so many RSUs when his company went through that acquisition. I'm sure there's other people who have hundreds of thousands of dollars in, whether it's restricted stock units or stock options. When you go to rebalance, I'm I even read your document. I'm still confused about how all this stuff works, Brian. Taxes. There's like all these different tax treatments for different types of stock options. I can imagine if you just go and sell $100,000 worth of some company stock that you own. I'm like, man, that's a big tax burden. Like, should I sell this? Should I not? Like, it's been such a huge gain since I started with this company 10 years ago. This is going to be a long conversation. I'm probably going to have even more questions, but want to just break down the different types of tax treatments and how all this stuff works?
Yeah, sure. This can get very complicated very quickly, and your specific situation is going to depend on you, your income, what state you live in, all kinds of things. But as a general rule, when it comes to taxes, there are ways to lower your personal tax bill. In the United States, the biggest one is to make sure that any stock that you own and hold qualifies for long-term capital gains, not short-term capital gains. So when it comes to those stock options that we talked about, which is the right to purchase a stock at a future date at a future price, just holding the stock option does not trigger anything about long-term capital gains. However, if you have incentive stock options, which are given to employees, you can exercise them, take ownership of that stock, and if you don't sell it, what that will do is it'll start the clock for you actually owning the stock, so it can become a long-term gain on any sale after a year. Now, to do so, you're taking on the risk that that stock price will be at least stable over the next year. And if that stock declines, well, so too does the value of your stock. On the flip side, it could go up. So you could actually make money by holding it for a year. So if you have incentive stock options and you believe in the future of the company, there can be a benefit to exercising them as soon as you possibly can, holding on to that stock, and then selling it at a later date, which would potentially lower your tax bill. Now, you can't do that with non-qualified stock options or NSOs, and those are sometimes given to employees, and that is just the stock options. Restricted stock, which is when your employer gives you stock, right? Here, this is now yours. You instantly take ownership of it. That is unfortunately taxed as ordinary income when that stock becomes yours. It's effectively taxed as income because you are effectively getting income from taking ownership of that stock. Now, if that stock increases in value and you hold it for a year, then the extra value will be taxed at a lower rate. But make no mistake that restricted stock is taxed at a higher rate. So that's why it's very common when let's say an employee got 1,000 shares of stock of RSUs granted to them. It's fairly common for that employee to sell a few hundred shares to take care of the tax burden for that ownership. So, but this is like one of those like. The downside is you're paying taxes because you made a ton of money situation. Yeah. So yes, it's not all sunshines and rainbows, but when you're paying a huge tax bill, that's usually because you made a lot of money.
Yeah. And as far as like, I guess a little asterisk thing for listeners to look out for when you're talking about paying taxes is, I know in my experience, those taxes were taken out of those RSUs when they were given to me. And the way it actually worked was they were selling some of those shares to cover. So let's say I'm supposed to be getting 10 shares this month as part of my grant. Maybe 7 actually only show up in my account. And you might be thinking, what in the world's going on? They withheld 3 to pay for those taxes so that I don't later have to pay for those taxes. Now, the thing to watch out for is, let's say you're doing your own taxes, you're doing your own TurboTax, and you pull up like your cost basis. If you're looking at the wrong screen, it could make it look like you paid $0 for this. Now it's worth 90. So you owe the full, but you've already paid taxes on it. So there's there's a chart that you can pull down that will show you basically like what you effectively paid for, like your adjusted cost basis based on the taxes you had already paid. So definitely be careful and don't accidentally double pay your taxes.
And this is why there are tax professionals, because this can get complicated fast.
Yeah.
I was so confused. I mean, I'm still confused reading through some of this stuff. I know there are some tax strategies. Like one thing that you had mentioned when we were chatting before was like the early exercise option, using tax deferred accounts. Whatever one you think is the best, let's start there, and then we can kind of just go down the list and make sure that people are doing this in the most optimal way possible.
Yeah, so it depends on what type of stock that you get, of course, but I would say that the biggest hack, quote unquote, is to just exercise your options early, especially if you believe in the long-term potential of the business and you think the value is going to grow. It can often be advantageous to pay a smaller bill up front and get that long-term vesting scheduling going as soon as you possibly can. Another option is if you get restricted stock, and it's worth money. You can take the money that you make and immediately use that to fund a 401k or max out your 401k or max out an IRA or max out an HSA. That way, you're taking like income that you're getting and you're essentially putting it into a tax deferred vehicle. And if you have room in an IRA or traditional 401k, you're earning income, but then you're putting it into a income deferred of savings investment vehicle, and doing so can help to minimize the tax burden. One final one I will point out is that if you are a charitable person, you can actually take the stock that you're given and you can actually donate it to a charity of your choice. And doing so, the charity can then sell that stock that you donated to them and not pay any taxes on the sale that you have. And that can also lower your tax burden because you're not taking ownership of it directly. You're giving it to a charity. Of course, then you don't get the money. The charity gets the money, but that can also be a way to lower your taxes. But generally speaking, beyond those, there's not a ton of strategies that I'm aware of to lower your tax bill, but those can at least help.
So this is jumping away from taxes, but I think it's another just little fundamental piece of understanding the mechanics behind all this. If you are someone who's thinking about taking an offer that involves stock compensation. So, we've kind of heard like, okay, maybe you're getting $100,000 worth of stock. Maybe you're getting 2,000 RSUs. Like, how does that actually work? Like when I get the offer and it says, because generally in my experience, it's a cash value that they're kind of promoting. Like we're going to give you $50,000 in RSUs. Let's say this is a publicly traded company. How does that actually work? What does that actually mean? Are they giving you $50,000 worth of stock? Does that mean you can count on it being worth 50,000? Like just what should the expectation management be for the person who is considering that offer?
So you're bringing up a really good point. And I want to go back to something that you said before when you were talking from an employer. You said that an employer may have had $10,000 in salary wiggle room, but $25,000 in stock wiggle room. One major benefit for the employer, the company that's issuing the stock to the employees, is that is a non-cash expense for them. That is a way that they can compensate their employees potentially really well and not have to use any cash to do so. So this is why startups, small companies that are often very cash strapped, right? They are running on venture-backed funds, or they don't have their business model in place, or they're not profitable. For them, cash is often very precious. And one reason why they pay out huge amounts of stock-based compensation is it doesn't reduce their cash balance to pay out these huge stock balances. So let's again stick with like Facebook. So Facebook comes to you, you're an employee, and they say, we want to give you 100,000 shares of stock. And they issue that to you as restricted stock units. Well, Facebook, as a corporation, literally has the power to all of a sudden create out of thin air 1,000 new shares of stock and just give you those shares of stock. And then you can take those shares of stock, go to the open market, sell them at the market price, and then earn that money. The reason that the downside for Facebook to do so, that sounds like magic, by the way, just making up things out of thin air and then immediately realizing value. The downside to doing so is that Facebook now has more shares of itself outstanding. And there are more shareholders that have a claim on Facebook, the company. So that is a factor. That's something called dilution. The more shares of a company exist, the less ownership stake each existing shareholder actually has a claim on. So think about like a cup of juice. Right? If you have a cup that's 100% juice and you take some water and you pour it in there, right? If you pour like 1% in there, you're not going to notice a difference. It's not going to be diluted that much. But if you keep pouring water in there, eventually the quality of the juice will be degraded significantly. Take that exact same mental model and apply it to stock-based to stocks. The more stock-based compensation a company gives out, the less valuable, at least in theory, each remaining share becomes.
And
So
just to
another
like,
term
I guess, oh, sorry.
you're good, Justin.
I was just going to say, and just like to tie off, I think the part that I was getting at is like, if you're looking at an offer and they say they're going to give you $100,000 worth of stock, what you could imagine will happen is, let's say you're getting hired in the 1st of June. They're going to have some date, maybe it's June 15th, where they're going to say, we're going to look at what the value of that stock is at that day. Let's say it's $100 a share. And then we're going to take that $100,000 and we're going to divide it by 100. That's going to tell us how many shares we're going to actually grant you. And then that number of shares is stable and will be given to you over that schedule. Now, the value of those shares could greatly change. But if you're in this position and you're looking at taking on the offer, you got that value that they're saying you're going to get, like 100,000, but it could be worth 120,000. It could be worth 80,000 by the time it actually gets to you, because they're going to take and convert that based on the price. And every company has a different rule, but it's normally like a 30-day rolling average around the date that they give you the stock.
Yep, that is completely accurate. Which, as a general statement, if you can actually time this, it's better to be hired by a company whose stock price is down significantly, than it is by one whose stock price is up significantly. All things held simply. I mean, imagine taking a job at eBay in 1999, when the value of their company was exploded higher because of the dot-com boom. Like, valuations were absolutely insane back then. So any stock that you were given in 1999, or any of the value of that, effectively became only a tenth of what it was worth then, or 5% it was worth just 2 years later, simply because valuations absolutely collapsed. But conversely, if you took that same job with eBay in 2002, which would be harder to get, by the way, but because the value of the stock was so depressed, it would actually have a much higher chance of becoming worth a lot of money in the future. So you're absolutely correct. The valuation, which is completely out of your control, of the company at the time when you're granted those options, does really matter. But that's not something that you have control over.
This might be a really dumb question, but it's one more definition thing where I honestly don't know the answer. I don't know the differences. I've heard the acronym ESPP, the Employee Stock Purchase Plan. Is that different from the scenario you were just giving at the very beginning, where you had the option to exercise at $1 the 2,000 shares? Are those two totally separate things? Because like I've heard on other podcasts, people are like, oh, I have this ESPP where I can buy shares at a 15% discount, yada yada yada. Again, this might be dumb, but I don't know the difference.
Nope. This is absolutely not dumb, because this is a whole this is related to stock, but it is not necessarily stock-based compensation. This is more of a benefit that is offered at some companies. So ESPP, Employee Stock Purchase Plan. It is essentially exactly what it sounds like. If you are at a company, some companies, as a benefit to their employees, offer them the ability to invest their own money into that company's stock, and often they can do so at a discount. The terms can be hugely varied depending on the company you work for, but in some cases, employee stock purchase plans can be a fabulous way to become a part owner in a company. When the company that I was working for, that I mentioned before, we had an ESPP plan, and here's how it worked. I would contribute money to my ESPP the same way you would contribute to a 401k. Money would come out of your paycheck essentially every period. And then every 6 months, the company would take the closing price of their stock, let's say it was $20, and then they would subtract 15% from that. So if it closed at 20, they would say, okay, you can buy and invest in this company at 17. So you were guaranteed to earn at least a 15% return on your money. And then all that money that I was saving up over that 6 months would get invested. It would buy the stock, and then those shares would instantaneously become mine, because I actually invested the capital into doing so. So it's fairly common to see a 15% discount on the closing price. However, one of my friends worked at a company very similar to mine, and their ESPP was way better. Theirs was same concept. You put money in, it grows for 6 months, but instead of buying it at the closing share price at a discount, the company actually looked at what was the lowest dollar amount that the share traded for over that 6 month period, and then they gave you a 15 or 20% discount. So you effectively got in at the lowest price that the stock traded at over the following previous 6 months. So instead of him buying at a 15% discount to the current price, he was buying at like a 60% discount to the current price. So that if I had access to that, I would have loaded up like crazy because you're buying it at such an incredible a discount. But ESPPs are you putting capital into the company, and there's often a little incentive for you to do so, but some of them can be absolutely fabulous.
And the plan that I was under was even slightly different than that. It was 15% below like what it was going into that 6-month frame. So like, let's say, you're starting in January to July, whatever it is in January, you take 15% off that. But they had a fail safe where if, let's say in July, the number actually landed lower than what 15% of the entry price was, then they would give it to you at that lowest price, not an additional 15% off of it. But again, this meant that like worst case scenario, you got it at exact market value at a time when the stock had dropped considerably, like obviously more than 15%, or, the stock has been increasing and you got it at 15% of the entry price and, you're saving more than 15% off the market value. So I always encouraged all of the people who worked with me to put in the maximum amount into the ESPP. I really did not see a lot of risk into going heavy into the ESPP. Obviously, the stock could completely, fall off the face of the earth. But if you read your plan, there's a potential that there's some fail safes in there so that if the stock actually drops more than 15%, you're still okay.
And once you take ownership of that stock, you can immediately sell it. So if you wanted to, I could have sold it literally the day that it hit my account. It's not like I had to wait or a vesting period. It instantaneously becomes mine. So if I did that, I would have earned a 15% immediate return minus what I would have to pay in short-term capital gains because I essentially own the stock for a matter of hours in that day. But you're absolutely correct, Justin. The details matter. Some of these plans can be no lose, like it's impossible to lose if you do them. Other ones are less generous.
And Brian, you mentioned it, but the only other little nuance I would say is the difference between like say an option is, you take your money out whenever you want to out of your checking account, go buy these things. Generally the SPP, like Brian said, is taken from payroll. So it's not, and it's something where it's set up on a schedule. It's not like you just wake up one morning and decide, I'm going to put $7,500 into my ESPP. You need to decide before that time even starts, before that 6-month period starts, how much you want to put into your ESPP, and then they'll divide it up out of each paycheck across that 6-month period.
Anything to add, Brian, before we round this thing out? I have learned a lot today. I've learned so much. I've been taking copious notes. I'm going to have a cup of coffee after this and just relax because my brain is working overtime.
As a general takeaway, stock-based compensation is a confusing topic. It's not something that there's a lot of general education about, but it can be a great topic for people that are interested in FI to study, because as I said, if you can work for the right business, you can effectively dramatically speed up your journey to FI if you can work for the right company. And a couple of things that I just want to throw out there. There's a couple of sectors that companies are in that are generally known for paying lots of stock-based compensation, while others are not known for paying stock-based compensation at all. The one that's the most common is technology. Specifically, if you can find an employer that is headquartered in California, hopefully in San Francisco, the war for talent around the Bay Area is so extreme that those companies are just used to paying huge amounts of stock-based compensation to their employees. And many of them have offices elsewhere or even offer remote work. So if you're on the job hunt, I would absolutely look for tech companies in the San Francisco Bay Area that I could become an employee at, even if I didn't live there. But it's a big positive if it's a tech company that's in California. Another sector that pays a lot of stock-based compensation is the financial sector. So if you're working for like a Goldman Sachs or Morgan Stanley or JP Morgan, a lot of companies like that also pay out pretty high levels of stock-based compensation. And one final thing I do want to point out there. If a company is publicly traded, and you can dig into the numbers a little bit more, you can actually tell what companies have very generous stock-based compensation plans and what companies have very stingy stock-based compensation plans. I've been working for myself for 4 years. I never plan on working for everybody else again. But if I did work for somebody else, the number one thing that I would look for would be a fast-growing company that's publicly traded that pays out huge amounts of stock-based compensation. And there are some actual tools out there. One I'll throw out there is a website called finchat.io. You can actually go in there and you can search for companies that pay very high amounts of stock-based compensation when compared to their revenue. And if you just sort by the highest number possible, the companies at the top of that list are very likely to have extremely generous stock-based compensation packages. So Instacart, C3.ai, Ginkgo Bioworks, those are the top 3 ones on my screen right now. So if you can get a job there, you are likely to do very well with stock-based compensation.
Well, Brian, thank you so much for giving the listeners some time. I know we hit them with a ton of information, and I certainly at no point wanted to steal any of your thunder. Hopefully it was just backing up some of the things you were saying and adding on to the credibility that you bring. So thank you for coming on the show and educating on everyone on a very important topic that not enough people talk about. Yeah, it's not like some crazy startup business, but it's actually a way for, I would say, a larger percentage of people to reach financial independence than, many of the topics that we get to cover.
Absolutely. Well, thank you for having me as always, Justin and Cody. It's awesome to be here.
And where do you want to point people? I know you're super active on Twitter, or I guess it's called X now. You have a bunch of resources. You have a book. Where do you want to send our listeners?
Yep. So follow me on whatever social platform suits your fancy. I'm on most of them. I'm most active on Twitter and LinkedIn. And check out my company website, which is longtermmindset.co.
Awesome. Appreciate it, man.
Thank you for having me.